Hello, and welcome to Compound Club. Most investors underestimate the quiet power of reinvesting their dividends. It doesn't make headlines, it doesn't happen overnight. But over time, it can turn small, consistent investments into extraordinary wealth. Today, we'll uncover how reinvesting dividends taps into the incredible force of compounding and why this single habit could shape your entire financial future. If you've been following my series on dividend investing, you already know dividends are regular payments from companies to their shareholders. They're the reward for owning a piece of a profitable business. But while receiving dividends feels great, reinvesting them is where the real magic happens. Reinvesting means taking the cash you earn from dividends and using it to buy more shares of the same company or other dividend-paying companies. And when you do this consistently, your portfolio begins to grow on its own like a snowball rolling downhill. Compounding is the process of earning returns on your past returns. It's simple in theory, but powerful in practice. When you reinvest dividends, those new shares you buy start generating their own dividends. Over time, those dividends are reinvested again and the cycle continues. Think of it like planting a tree that grows apples. Each year, you harvest the apples, plant the seeds, and soon you have an orchard. It starts small, but given enough time, your orchard becomes vast and the fruit keeps multiplying. Imagine you invest 1,000 pounds in a dividend-paying company that yields 4% per year. If you spend those dividends, you'll earn 40 pounds each year and that's it. But if you reinvest them, your next year's dividends are based on a slightly larger balance, 1,040 pounds. Now, that might not sound exciting, but keep doing it every year for 20 years and your investment grows to roughly 2,200 pounds. You've more than doubled your money simply by letting your dividends buy more shares automatically. And if you keep contributing fresh capital along the way, the results can be truly transformative. The hardest part about compounding isn't understanding it, it's trusting it. Because in the early years, the growth feels invisible, but eventually the numbers start to curve upwards and you realize your money is working harder than you are. Reinvesting dividends requires patience and discipline, but that's exactly why it works. While others chase quick gains, you're quietly building a machine that grows stronger every year. Many brokers and companies offer something called a dividend reinvestment plan, or DRIP. These plans automatically reinvest your dividends into more shares without you lifting a finger. It's a hands-free way to compound your wealth. And the best part? You're buying shares regularly, which means you're practicing pound cost averaging, smoothing out the ups and downs of the market over time. The longer your money stays invested, the more powerful compounding becomes. Each reinvested dividend adds to your base, and the base keeps getting larger. This is why starting early, even with small amounts, can make a huge difference. Because compounding doesn't just add wealth, it accelerates it. 10 years of reinvestment is good. 20 is great. 30 can be life-changing. Reinvesting dividends teaches you to think long-term. It shifts your focus from chasing price changes to building sustainable income. You stop worrying about daily market noise and start seeing yourself as a true business owner, someone who lets profits compound naturally. Remember, wealth isn't built overnight. It's built dividend by dividend, year after year. So, keep reinvesting, stay patient, and let time do the heavy lifting. If you found this video helpful, give it a like. Subscribe for more insights on dividend investing, and watch my previous video on the basics of dividend investing to continue your learning journey.